Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. We are here in the 24 hours following the tectonic FOMC announcement that we had yesterday, and the markets are digesting. So I thought this would be a good opportunity to get a bit of a view on how the dust is settling, what are some of the conclusions that have come out of this, and to get a bit tactical and look at what all of this means for the narrative that we've been talking about really since late last year, which is this very unique role for the US dollar in these kinds of environments of economic turmoil and transition, and to see what all of this actually means from a tradable perspective. So let's begin by looking at what has actually happened with the Fed. What has actually been the response from markets? Obviously, we've heard all manner of hot takes from this corner and that. We've heard all manner of interpretation from various kind of corners of the asset universe. But let's actually see what the markets themselves in the price action itself signaling here. So what you see on the screen is, first of all, the current policy curve in the solid green. So you can see we're at an effective rate of 4.9 now. So we're right in the middle of that 4.75 to 5 range. You can see that within a month or two, we are looking at a peak in rates at 5.1%, right in line with what the Fed Summary of Economic Projections document showed us yesterday, and indeed unchanged from what the preceding one was telling us in December, and thereafter a rapid rate cut cycle. So by September here, so 6 months out, you can see we're at 4.7, which means we are pressuring the lower end of the current range. By a year from now, we are essentially back to 4%. So over the course of the next year, this is telling us we are going to shave 100 basis points. We're going to see a full 1% rate cut from current levels. This is a very stark contrast from where we were before the SVB collapse, and that's the small dashed curve there, which you can see was envisioning a peak rate at around 5.5, and a year from now, a rate still north of 5%. And so it is almost as though, looking at the dashed line there since the prior FOMC in early February, it's almost as though neither the bank collapse nor the run-up in U.S. economic data have occurred. It's almost as if we're back in late December, early February. The yield curve looks a little bit firmer at the front end, out to the 3 to 6 month range, and then a little bit shallower from the 6 month to the 1 year area. And then things basically reconfigure and reconverge into the 2 to 3 year window. Before we were a little bit under 3 for the 3 year rate. Now it looks like we're going to land at the 3. But you can very clearly see here the sequencing. The curve shot all the way out because that stronger economic data that we saw in February and the beginning of March gave us much more pronounced Fed rate hike odds and a much more extended period that rates remain high once they stop rising. And then SVB occurs and we crash all the way back down into a curve that's more humped in the front, more steep in terms of the way that it's going down toward the end. So in other words, the hold at higher rates is much more brief, and the peak in rates is much more shallow. That's where we've landed in the wake of this Fed announcement and everything that led into it. If you look at the breakdown in expectations, what you are seeing is there is maybe a 33% chance of another hike at the May meeting. So we're overwhelmingly geared in the direction of no change. In June, there is maybe a shallow probability of a cut, about 58%. A little bit better than even not aggressive. So again, through June, looks like it's a likely hold. But come July, we're looking at one cut in July, two cuts by September. Notice the implied rate delta column has a decline of 54 basis points by September as relative to current rates. So we are talking about the pricing in of two full cuts at 25 basis points apiece by September. Come November, you're looking at the two cuts fully in the market and an 87% chance of a third. You've baked in 72 basis points out of the 75 in those cuts. By the time you get to December, those cuts are in. They're priced in. And you're looking at a 46% chance, if you look at that number of hikes cuts column, of a fourth. So you've baked in 87 basis points, looking at the implied rate delta column. Out of the 100, that would be a full percentage point cut. And by January, it is there. So you're down a full percentage point from current setting come January. This is a very aggressive easing cycle that is being baked in here. Now, how did we get here? What is it that the Fed is seeing, and what is it that the markets are extrapolating? Well, take a look. The orange line there on the chart is the 12-month forward outlook for where Fed funds rate futures are saying the Fed policy rate will be in a year's time. Notice that orange line was running up in February and has subsequently crashed. So that run-up was through February, the move to that peak rate near 5.5. And then, of course, the crash comes as you get a pickup in financial stress. That would be SVB. That's the blue line there, surging higher. What you've seen since the initial dust has settled is that the blue line has stabilized but has not fallen back to pre-crisis levels. So whatever the markets are seeing here, they are seeing still elevated funding stress, still elevated credit risk. And arguably, that's why we haven't had the rebuild of Fed rate hike odds, and that's why we look so dovish on the forward outlook. Because the markets still perceive that there is a significant issue, that there is still something ugly on the bottom of the pool, and as we drain liquidity, that ugliness will reveal itself, that we are not done, that SVB, Credit Suisse, Signature Bank, that all of this was the tip of an iceberg, not the whole thing. Meanwhile, what you have is a U.S. economy that still looks quite robust. U.S. economic data continues the trend that we started in February that gave us those building Fed rate hike odds. It's still improving. We still have outcomes coming in not only outperforming expectations, but to a greater extent. So economists' models are still too pessimistic for what the U.S. economy is actually giving them. But of course, the upshot of that is inflation. If the economy is in fact ramped up, but the Fed is easing back and we've not had a rebuild in rate hike odds, and in fact the markets expect aggressive tightening as we saw right here, well then what this leads into is a rebuild of inflation expectations. And indeed, you can see here the 2-year break even, which is our measure of the market's implied inflation outlook over the Fed's policy window, the 2-year window here. The March reading, that last yellow bar there, is 2.8%. That's been climbing as the risk has eased. And so what we end up with then is a situation where the Fed still looks off sides as relative to its 2% inflation target. You can see that the pickup in economic activity in February gave us a break even at 3.2. You can see that the current setting for it as we approach the end of March at 2.8 is clearly further away from the target of 2 than it is close to it. And as the risk at least stabilizes, which is what we see right here, that number seems to be going up. There it is right here, zoomed in. So the red line there is that same 2-year break even that we had in the yellow bars on the prior chart. And there's that financial stress index. As that stress index has come off the highs and gotten anchored, so too the break-even rate has come off the lows and edged higher, which presents an interesting conundrum. On the one hand, we have a situation where we're being told we don't need to backstop all depositors. This is what the Treasury Secretary, Janet Yellen, has been telling us for 2 days. We don't have a problem. We don't need to backstop all depositors. In any case, that would require an act of Congress. That's not something on the menu here. But we don't need to backstop all depositors. Everything's fine. We have the tools in place to backstop when things go awry. So everybody should feel very confident. Everything's going to be fine. Look, she would posit, SVB was not a systemically significant bank. Signature was not a systemically significant bank. First Republic is not a systemically significant bank, at least in sort of legislative terms, based on how systemically significant too big to fail banks have been defined. But clearly, when they ran into issues, authorities were able to corral the FDIC and its financial backers, which are in fact the large banks, to get all this together. So in a sense, what you have is a situation where the bleeding has stopped because you have a kind of de facto deposit guarantee that is all-encompassing. Because what you then get from the systemically significant banks is a kind of funnel for the government backstop. So the government says, we've backstopped the big banks. Now you, the big banks, it's on you to make sure that these little banks are liquid and don't go under. So you don't have a capital constraint because we have your back. Now you go make sure they don't have a capital constraint. And that's worked with SVB. It's worked with Signature, it looks like. It's worked with First Republic for the most part. It looks like, for now. But the essence of this setup is instability. Because essentially, you need for a small bank to run into an issue in order for this process to kick in. And the big banks have every incentive to come in at the last possible moment, so that whatever little bank needs recapitalization becomes as cheap as possible. And its deposits can then be absorbed with the biggest discount. So these banks, the systemically significant banks, they have every incentive here to let the big issues that might emerge at whatever smaller lenders become as big as they possibly could without upsetting the entire apple cart. So they could come in and basically buy those deposits for pennies on the dollar, as few pennies as possible. And while that doesn't necessarily say that we are on the cusp of a crisis, because there is this backstop, and so maybe the whole thing doesn't come apart, but what you do have is a setup that encourages perpetual little crises to continue. And we, of course, know that monetary policy comes with long and variable lags, to use the cliche. We know that we've had a vast amount of tightening that's already occurred, and that's maybe halfway absorbed into the economy, optimistically. But if you look at the Fed's own prognostications, not even a third absorbed yet. And so with that in mind, you have a long tail of continued issues at these little banks and other institutions exposed to rising borrowing costs and compounding tightening, which is what the blue line is telling you there. And so you find yourself in a difficult thing to reconcile, which you can see here when we look at that index as relative to the S&P. So you can see there, over the course of February, when that stress index stops falling because rate hikes are expected to be more expansive, the S&P falls. You can see that fall becomes really aggressive toward the beginning of March, and of course that's where the stress index surges. That's SVB and the crisis. As the stress index stalls, stocks recover. But something real interesting starts to happen over the past 24 to 48 hours. Is stocks and the stress index fall together. This is very, very telling. It's early days yet, but what this is saying, what this is flagging, is the inherent dichotomy in the current situation. If there is something wrong, if we're going to have perpetual bumps in the road here because of the way we've set this up, and so it makes sense that the financial stress index isn't falling back, well, then you have lots of uncertainty, lots of things that are about to go bang in the night, lots more worrying headlines, so you get risk aversion in stocks. If the Fed and the Treasury are right, and you don't have an issue, and everything is contained, well, then the index of financial stress should continue coming in. But then, of course, the flip side of that is inflation expectations build again. because, again, the economy is doing reasonably well, these issues aside. And that means rate hike odds need to rebuild. And that's risk off. So you find this situation here where the markets have very little to like about any of this, whether the Fed and the Treasury are taken at face value or they are not. And this, of course, brings us to something that is a favorite of mine, the dollar smile. And all credit to Steve and Jen for developing this years ago. This really paints the dollar's unique role in the global financial system in very stark relief. What you see on the lower axis is the performance of U.S. GDP relative to other G7 economies. So when the numbers get negative, that's the U.S. severely underperforming. When the numbers get positive, that's the U.S. severely outperforming. And on the y-axis, you have the dollar. In this case, we're using the DX future, which approximates the USD index. That's the underlying there. So what you're seeing then is the dollar does well, meaning it tends to be higher, when the U.S. economy is either doing very poorly or very well. It's when it's middling relative to everybody else that the dollar is weak. This speaks to the dollar's dual role in the financial system. It is, of course, as we know, the indisputably dominant medium of exchange for global commerce. I never get tired of citing this little factoid. The Bank of International Settlements has over 80% of global monetary transactions occurring in dollars, ultimately. So it is unrivaled in its liquidity. And of course, the more liquid something is, the less volatile it is. It also doesn't hurt that with this liquidity comes a posture from U.S. authorities that doesn't mind a stronger dollar, because the U.S. is a consumption-led economy, not an export-led economy. Were it an export-led economy, we'd be concerned that a stronger dollar will make U.S. exports more expensive relative to the international competition, drive away demand, and hurt the economy. But the U.S. is a consumption-led economy. And so a stronger dollar actually boosts those consumers' purchasing power of foreign goods and services. And it's actually a good thing, because it encourages consumer confidence, it encourages spending, and consumer spending is what drives U.S. growth and accounts for about 3/4 of it. So that's how you get this smile structure. When the U.S. economy is doing relatively well, you have a story about rate hikes, inflation, and thereby a yield-based narrative that's supportive for the U.S. dollar, because as the economy does well, as the data looks strong, rate hike odds build. One person's borrowing costs is another person's lending income, and therefore, holders of dollars can look forward to rising income, because, of course, they can then lend those dollars out at higher rates, so the dollar goes up. On the other side of the smile, things are going terribly, and what you have is risk aversion, because the world's largest economy is having some variety of issue. Capital comes out of risky assets, and of course, where does it go? Where do people cash out? Well, it only makes sense that they would cash out into the most liquid currency available, because that's the one able to absorb all of that cashing out without becoming terribly volatile. So there's a store of value consideration there. And secondly, you're not going to get official pushback because, as we've just said, U.S. authorities don't care if the dollar becomes stronger. They actually welcome it. And so, if you look on the right side of the smile, you have February. And increasingly, especially after the Fed, if you look at the left side of the smile, you have where we are today. Very tellingly, yields are down. The dollar is down against the yen. That exchange rate very sensitive to the yield spreads between the dollar and the yen. Of course, there's not much yield of any kind for the yen, and clearly the picture for the dollar has become less yield supportive, as we've just seen. But the dollar is strong against the Aussie. It's strong against other risk-sensitive currencies. It's even rebuilding strength against the euro. And that is a story about risk aversion. And so either we take the Fed and the Treasury at face value, and we don't have a banking crisis issue that's ongoing, but the economy is strong, and so we get rate hikes coming back into the forecast, right side of the smile, or there is an issue. The rate cut expectations are correct. We are going to have this perpetual risk of ongoing issues spilling out every so often as the tightening builds and is absorbed into the economy, even that tightening which has already been done. Banks come to the rescue late, and there's risk aversion. That's the left side of the smile. But either way you slice it, it seems to bode well for the greenback. So here we have the Invesco Deutsche Bank Bullish USD ETF. Ticker is UUP. This is a monthly chart. You can see it has pulled back to find support right around 27.19. That's the top of the range that had been containing the US dollar since its rally around the risk aversion in 2008. We took that level out last year against the backdrop of those aggressive rate hikes from the Fed getting started. As we now start to look at maybe those rate hikes being over, there's been a transition period. And so the dollar has pulled back and very tellingly could not break back under that level. As a matter of fact, not only did it find support there, but it's now completed a very dramatic looking bullish engulfing candlestick pattern, which tells you we may be in for the next leg of this dollar rally, which has been with us really since 2011, but most emphatically since 2014. So the structural advance in the greenback seemingly about to launch into its next act. And that is where we find ourselves in the wake of everything that's transpired really in the past 2 weeks. This has been Macro Money. Thank you very much, as ever, for joining. We are here Monday through Thursday every single week, right after overtime, with our friend Chris Vecchio, head of Futures and Forex. I am also on with him right before this show. I'll also be back with Chris for Futures Power Hour tomorrow and every Friday. And then back on Sunday for First Call with Tom and Tony. Outside of those shows, you can catch my various thoughts on markets via Twitter at Ilya Spivak. Thanks very much, everybody. See you tomorrow. Take care.